Hey everyone, me Kevin here. Jerome Powell just had a 60 minutes interview, and folks, 60 minutes with Jerome Powell, you know you're getting somewhere from me, Kevin, because we got to pay attention to what J. Powell says. It can mean a lot for the future of our portfolio. So, without further ado, let's get right into it. I do want to mention that this video is sponsored by Lemonade, though. If you want to get life insurance, we've got pet insurance, homeowners insurance, and rental insurance. I am now sponsored by Lemonade. So check that out by going to metkevin.com/lemonade, and you too could sign up for a quote with their awesome AI. metkevin.com/lemonade. Okay, let's get into the transcript. So Jerome Powell talks about the economy being at an inflection point. Boy, oh boy, we like inflection points on this channel. That is something I regularly talk about, is identifying changes or shifts in the way the markets are moving. For example, an inflection point would look like this. If things are going up, 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 and all of a sudden the trend changes down, right there is your inflection point. Those are very important things to pay attention to. So Jerome Powell says that we are at an inflection point because, right here, we feel like we're at a place where the economy is about to start growing much more quickly and job creation coming in much more quickly, or that we'll have more jobs quickly. So the big risk right now is COVID spreading again. But otherwise, he kind of feels like we're at this explosion of a potential turning point in the markets where the economy could grow very, very fast and very quickly. And this is because of a combination of the vaccines, strong monetary support from the Fed, and also strong stimulus from the government. So the outlook has really brightened. And as far as outlook, Jerome Powell sees GDP growing this year between 6 to 7%, which is the highest level in around the last 30 years. And unemployment might get down to around 4.5%, 4% to 5%, somewhere in that range, 4 to 5%. And so Scott asks the question here, so you're expecting a boom rather than a recovery. Jerome Powell corrects this and says, well, I would say that this growth that we're expecting in the second half of this year is going to be very strong. All right, let's keep moving on. So Jerome Powell further says that this is a very kind of unusual recovery, especially the industries with direct contact to the public suffering as much as they are. And Jerome Powell believes it's going to take some time for restaurants and retail and travel to all get back up to the levels of where they used to be. And Jerome Powell says we're going to support this economic recovery until it's really complete. And so these are I'm always looking for little changes in the ways he's saying things. And this is something I haven't actually heard him say before. I've never heard him say we're going to support the economy until the recovery is really complete. So I always look for those little modest changes in the things Jerome Powell is saying, and that there is one of them. Kind of doubling down on how supportive he wants to be. Although they did show a clip of somebody who had lost their job, and maybe this was more out of empathy than a signal to the markets. Jerome Powell then goes on to say, look, we don't have the answer to everything, but their goal overall is really trying to help people. The problem, though, with the Fed, and we know this, is as the Fed keeps rates low, it's generally the wealthier people who get supported more than poorer folks. And that's very unfortunate. That's sort of what exacerbates the case-shaped recovery that we regularly see, and it's unfortunate. All right, we spoke to Powell 11 months ago, and at the time, the Fed's worst-case predictions were, as he puts it, unspeakable. Now, Jerome Powell responds and says, hey, look, Congress has, at this point, effectively replaced people's incomes, kept people in their homes, kept them solvent, kept their lives together with what they did in the CARES Act. It was heroic. Jerome Powell's calling what Congress did heroic to keep things stable, or as stable as possible. He does lament the fact that over 550,000 folks have passed away from COVID-19, but says, look, even the Fed tried to do what they can or could by taking advantage of emergency lending powers and dropping benchmark interest rates to zero. Now, one of the things the 60 Minutes staff asked Jerome Powell is, why is it that investors have borrowed more than $800 billion to speculate in stocks? So borrowed more than $800 billion in margin to speculate on stocks. And he says, Well, the thing that Jerome Powell does and the Fed is they don't necessarily look at individual speculation, like how much margin our people are taking out, but they do look at the broader system. So they're looking at how are banks doing, how well capitalized are banks, are we having any kind of credit freezes or crunches where all of a sudden people can't access debt anymore, and that would be more of an issue that Jerome Powell is paying attention to, and whether or not these companies or banks or financial institutions are able to withstand significant shocks. Say valuations did fall substantially. And so here's a good line I'll read. And I would say, some asset prices are elevated by historic metrics. Of course, there are people who think that the stock market is not overvalued or it wouldn't be at this level. We don't think that we have the ability to identify asset bubbles perfectly, so instead we focus on having a strong financial system that is resilient to significant shocks, including if values were to go down. And this is true. They do stress tests of banks and other forms of stress tests that try to determine, okay, what would happen if the market sold off 50%? How would banks survive? Just as an example. And so those shocks are what they're looking to pay attention to. But one thing that I got from this that I thought was really interesting was this line right here. We don't think we have the ability to identify asset bubbles perfectly. And I think many folks watching this video now would say, it's pretty obvious. Stocks feel like they're in a bubble. Bitcoin feels like it's in a bubble. Real estate feels like it's in a bubble. Everything feels, it's the everything bubble, right? So this actually leads the crew over 60 Minutes to ask the question, what are the chances of a systemic breakdown like we had in 2008, another global financial crisis, right? We usually look to history and identify basically patterns to say, okay, well, this is just going to repeat itself. But usually we get different causes. And so maybe looking at 2008 isn't the best thing to do. Jerome Powell actually has a different answer for us, though, in terms of what to look forward to. So he gives us some insight. He says, look, the chances that we would have a breakdown that looked anything like what we had in 2008, where banks were making terrible loans, remember the ninja loans, no income, no job, no asset loans, investment decisions, terrible investment decisions, and needing to have low levels of liquidity and weak capital positions, and government bailouts, the chances of all of that again, he says, that is, the chances of 2008 all over again, very, very low. Very low. But the world changes and risks evolve. And so that's where he brings up his big new risk. His big new risk, cyber risk. He says that's where the risk, I would say, is now, rather than in something that looked like the global financial crisis. He says there are scenarios in which large financial institutions would lose the ability to track the payments that they're making in the event of some kind of cyber hacks or cyber attacks. And he says that could lead a broader part of the financial system to come to a halt. And that obviously would be very, very bad because that would lead to frozen credit lines, a lack of lending, and the entire thing could stall. Very, very bad. But it's interesting because it's not really a risk that we generally talk about, I feel like, on YouTube. The cybersecurity risk relative to like the risk of overvaluations in real estate or an eviction crisis or a stock bubble in electric vehicles or so on. Furthermore, the Fed's mandate, he says, is to keep the economy warm enough to produce maximum employment, but not so hot to set off a runaway inflation. This is a little bit of a softening for me. I've never heard this analogy before. Maybe he's made it before. Maybe I haven't paid attention to it. But usually he says our mandate is to have stable prices and maximum employment. And then he talks about how important it is to get people of minority descent or for women to get back to maximum employment. But here he's actually striking a new balance. He's saying, our job is to keep the oven, so to speak, warm enough so that our tendies bake nicely, but also not too hot to where we overcook our tendies and end up with a bunch of stinky inflation. It's a little bit of a softening there. So remember, I'm looking for those changes in what he's saying, and that's one of them for sure. The other softening was right here. We're going to continue to support the economic recovery until it's really complete. So that was bullish. But then this was a little bit more potentially bearish on, we do have to keep an eye on that inflation. So you're kind of getting a little bit of both sides there. But anyway, then he does get asked, will the Fed raise rates and tap the brakes before inflation happens? That's usually what you've done, so aren't you going to do that again? And he says, no, we're not planning on doing that. Instead, we can afford to wait to see actual inflation appear before we raise rates. Now, we don't want inflation to go materially above 2% and go back to, the bad old inflation days that we had when you and I were in college a long time ago. In other words, the 70s and 80s, back when we had really, really high inflation that was ridiculous, the 10 to 15% inflation, 18% inflation, those were some crazy times. Now, we don't expect to go back to those, or rather, maybe Jerome Powell says we do not want to go back to those. So he's saying, hey, look, we can afford to watch inflation go up, but we expect that inflation is going to curve back down. And if it overheats, then we'll act. Of course, this is where a lot of people debate that and say, hey, man, once you let the genie out of the bottle, you ain't getting it to go back down. Wishful thinking. Well, and everybody's going to have their own opinion on that one, of course. All right, so, but at this time, he says we do have the ability to wait to see real inflation, and that's what we're planning on doing. And what we mean by real inflation is 2% on a sustainable basis, so 2% over and over and over and over and over again. And when we get above to 2% or above 2% over and over and over again, he says that's when we will raise interest rates. Then he goes over here and says, here's the issue with raising prices. He says the globalization of the economy, so the issue with inflation, or in other words, things that keep prices lower, he says globalization of the economy and technology have enabled manufacturing to take place all around the world. Both deflationary pushes. If you can manufacture something somewhere else cheaper, that's deflationary. Technology makes things easier to produce, also deflationary. Then he says, it's very hard for people in wealthy countries to raise prices or raise wages, which that second part sucks a little bit. Like, we don't want to hear that we don't want to hear that wages can't go up, right? But he says, it's hard for workers to raise wages when wages can move overseas. It's just a different economy. And this is part of his overall argument that inflation dynamics are trending more towards disinflation than hyperinflation. This is Jerome's argument, okay? It's J. Powell. It's the dude with the money printer, right? Anyway, Jerome Powell, I think it's highly unlikely that we would raise rates anything like this year. No. So this is when he's asked, let me read this in context. So all the way through the end of this year, you wouldn't see rates increasing. I think it's highly unlikely we'd raise rates anything like this year. No. So in other words, no, not planning on increasing rates this year. And then we do have 60 Minutes that says other members of the Federal Reserve Board don't even see a rate increase in 2022. However, there are, I believe, 4 to 6 that do see a rate increase in 2022, but nothing for 2021. So really kind of reiterating more of what we're very used to with Jerome Powell here. A couple changes, though, a little bit of softening on the way he's describing his job of kind of keeping that temperature perfectly balanced, waiting for that actual inflation. 2% is his number, and he wants to see 2% over and over and over again. My guess is probably for 3 to 6 months, he'd want to see it stabilize at over 2% and then say, okay, let's raise rates, which probably would be a 2022 event. We'll see. And the biggest risk right now is not a 2008 bubble pop. It's actually cyber risk. So I don't know if that's a little like a red herring, like, hey, don't look at the market, look over here. And I don't know why all of a sudden I sounded like Barney, but I guess everybody's going to have to make their own conclusion on that one. Anywho, thank you so much for watching. Make sure to get your insurance with Lemonade. Go to metkevin.com/lemonade. Remember, they got life insurance, homeowners insurance, renters insurance, and pet insurance. Check them out. You will absolutely love them. Thank you so much for watching, and we'll see you in the next one.